the U.S. stock market experienced a dramatic plunge, sending shockwaves through Wall Street and beyond. The catalyst? Renewed trade tensions and President Trump's escalating attacks on Federal Reserve Chair Jerome Powell. Investors, already on edge, reacted swiftly to the uncertainty, triggering a massive sell-off. This sent major indices tumbling and the dollar to multi-year lows. The air is thick with fear and uncertainty. Is this a temporary blip or a harbinger of worse things to come? The Dow Jones Industrial Average, a bellwether for the U.S. stock market, plummeted over 1,200 points, a staggering 3.1% drop. This dramatic fall marked one of the worst trading days in recent memory, erasing months of gains and sending a chill down the spines of investors. The sudden drop has left many questioning the stability of the market and the potential for a prolonged downturn. The S&P 500, a broader measure of the market, fared no better, plunging 3.3% and edging closer to bear market territory. This index, which includes a diverse range of companies, reflects the widespread impact of the market turmoil. Investors on the trading floor were visibly stressed, with many reacting to the falling stock prices on their computer screens. The financial news headlines were dominated by the market crash, further fueling the anxiety among market participants. The tech-heavy Nasdaq Composite Index, home to some of the market's most volatile stocks, suffered the most significant losses, plummeting 3.6%. This decline reflects the vulnerability of the tech sector, which had been a major driver of the market's long bull run. As investors flee to safer havens, tech stocks, often perceived as riskier assets, are bearing the brunt of the sell-off. The rapid sell-off in tech stocks has raised concerns about the future of innovation-driven growth in the market. The dollar, typically a safe haven during times of global uncertainty, also took a hit, falling to its lowest level against major currencies in over 2 years. This decline in the dollar's value is a clear indication of waning confidence in the U.S. economy and the potential for further turmoil ahead. Meanwhile, gold, the ultimate safe haven asset, surged to record highs as investors sought refuge from the storm raging through financial markets. The rising gold prices highlight the growing fear and uncertainty among investors. The bond market, often a leading indicator of economic sentiment, also flashed warning signs. The yield on the benchmark 10-year Treasury note, a key gauge of investor confidence, spiked to its highest level in over a week. This upward movement in yields suggests growing concerns about inflation and the potential for the Federal Reserve to raise interest rates in response. The financial landscape is becoming increasingly complex, with multiple factors contributing to the current market volatility. Investors are closely monitoring the Federal Reserve's actions and the broader economic indicators to gauge the future direction of the market. As the market continues to navigate through these turbulent times, the focus remains on finding stability and mitigating risks. The coming weeks will be crucial in determining whether this is a temporary setback or the beginning of a more significant market correction. Investors are advised to stay informed and consider diversifying their portfolios to protect against potential losses. The bond market, often a leading indicator of economic sentiment, also flashed warning signs. The yield on the benchmark 10-year Treasury note, a key gauge of investor confidence, spiked to its highest level in over a week. This upward movement in yields suggests growing concerns about inflation and the potential for the Federal Reserve to raise interest rates in response. As the market grapples with these challenges, the actions of the Federal Reserve and other central banks will be closely watched. Their decisions will play a crucial role in shaping the future trajectory of the global economy and financial markets. President Trump, never one to shy away from confrontation, has once again trained his sights on Federal Reserve Chair Jerome Powell. This ongoing feud has become a hallmark of Trump's presidency, reflecting his unorthodox approach to economic policy and governance. Trump's latest salvo, a barrage of scathing criticisms delivered via his preferred platform, Truth Social, has further escalated tensions between the White House and the nation's central bank. These posts, often laced with sharp rhetoric, have become a regular feature of Trump's communication strategy. Jerome Powell is a major loser, Trump declared in one particularly vitriolic post, accusing the Fed chair of incompetence and sabotage. Such personal attacks are unprecedented in the history of presidential interactions with the Federal Reserve. Trump's primary grievance stems from the Fed's recent interest rate hikes, which he blames for slowing economic growth and undermining his efforts to renegotiate trade deals. He argues that these rate increases have made it more difficult for businesses to borrow and invest, thereby stifling economic momentum. "We need lower rates, and we need them now," Trump has repeatedly asserted, arguing that the current low inflation environment provides ample room for the Fed to cut rates without risking runaway price increases. He believes that lower rates would spur economic activity and support his broader economic agenda. Trump's attacks on Powell are not new. Since taking office, Trump has consistently pressured the Fed to adopt looser monetary policies, often breaking with decades of presidential precedent by publicly criticizing the central bank's decisions. This has led to a highly unusual and public clash between the executive branch and the Federal Reserve. This relentless pressure campaign has raised concerns about the erosion of the Fed's independence, a cornerstone of a stable and credible monetary policy. The independence of the Federal Reserve is seen as crucial for making unbiased economic decisions free from political influence. Some analysts believe that Trump's attacks on Powell are motivated by a desire to deflect blame for any economic slowdown ahead of the 2026 presidential election. By shifting the focus to the Fed, Trump aims to shield himself from potential political fallout. By scapegoating the Fed, Trump can argue that the economy would be thriving if not for the central bank's misguided policies. This narrative allows him to maintain his image as a champion of economic growth and a critic of what he perceives as bureaucratic obstacles. This strategy, however, risks undermining confidence in the U.S. economy and could backfire if it leads to market instability. The delicate balance of economic policy and market perception is crucial, and any misstep could have far-reaching consequences. The U.S. economy is navigating a treacherous path caught between the competing forces of inflation and recession. This delicate balance is a source of anxiety for policymakers, businesses, and consumers alike. On one hand, the robust labor market, with unemployment near historic lows, suggests a healthy economy firing on all cylinders. Job creation remains strong, and many sectors are experiencing growth, providing a sense of stability and optimism. Consumer spending, a key driver of economic growth, remains strong, fueled by low interest rates and a tight labor market that is pushing wages higher. This spending power is evident in bustling malls and supermarkets, where consumers continue to open their wallets. However, lurking beneath the surface are signs of potential trouble. Economic warning signs are beginning to flash, and financial analysts are increasingly concerned about the sustainability of this growth. Inflation, though currently subdued, is showing signs of life, fueled by rising energy and housing costs. These increases are starting to pinch consumers' wallets, raising concerns about future price stability. The ongoing trade war with China, which has resulted in higher tariffs on a wide range of goods, is also contributing to inflationary pressures. These tariffs are making imported goods more expensive, adding to the cost burden on businesses and consumers. The Federal Reserve, tasked with maintaining price stability, is keeping a watchful eye on these developments, ready to raise interest rates if inflation shows signs of accelerating. Their decisions will be crucial in steering the economy through these turbulent times. At the same time, there are growing concerns about a potential economic slowdown. Empty storefronts and closed businesses are becoming more common, signaling that not all is well beneath the surface. The global economy is losing steam, weighed down by trade tensions and geopolitical uncertainty. These international issues are creating ripple effects that are felt domestically, adding to the complexity of the economic landscape. The ongoing trade war with China, which has disrupted global supply chains and dampened business investment, is a major source of uncertainty. Businesses are hesitant to invest in new projects, fearing further disruptions and increased costs. The Federal Reserve, acutely aware of these risks, is carefully weighing the potential need for interest rate cuts to stimulate economic growth. Their deliberations are critical as they seek to balance the dual threats of inflation and recession. The U.S. economy is at a crossroads. Decisions made in the coming months will have long-lasting impacts on the economic trajectory, influencing everything from job creation to consumer confidence. The current expansion, now in its 11th year, is the longest on record, but it is showing signs of age. As the economy matures, the challenges of sustaining growth become more pronounced. The Federal Reserve, caught between the competing risks of inflation and recession, faces a delicate balancing act. Their policy decisions will need to be finely tuned to navigate these dual threats effectively. Navigating this challenging environment will require careful judgment and a steady hand on the monetary policy tiller. The path forward is fraught with uncertainty, but with prudent decision-making, the economy can be steered towards stability and growth.
Well, international markets are reacting quite strongly to the latest developments. We're seeing fluctuations across Europe and Asia, with investors trying to make sense of the situation. It's a bit of a mixed bag right now, but the overall sentiment seems to be one of caution. Traders are definitely keeping a close eye on any further announcements.
The ripple effects are being felt across Silicon Valley. Startups are finding it harder to secure funding, and even established tech giants are reassessing their strategies. The uncertainty is palpable, and everyone is bracing for what comes next.
Looking ahead, we have several key events that could act as potential triggers. The upcoming Federal Reserve meeting, quarterly earnings reports, and geopolitical tensions are all factors that could significantly impact the market. Stay tuned as we continue to monitor these developments closely.
Public opinion is sharply divided on the issue of central bank independence. Some argue that the Federal Reserve needs more oversight to ensure accountability, while others believe that political interference could undermine its effectiveness. It's a debate that shows no signs of cooling down anytime soon.
The current administration's economic policies are under intense scrutiny, and the legacy of these decisions will be felt for years to come. Whether these policies will be seen as a success or a failure largely depends on how they navigate the challenges ahead. It's a legacy on the line, and only time will tell how history will judge it.